Thank you very much, Coble Craven's team, for joining us today. For all my decision analyst colleagues, this is the firm that is our advisor, and probably, many other terms that I don't know to pull up right now, but they have been partners with us for many years. They help with our 401k and other types of advising one-on-one and corporately. So they're here to talk to us today, as you can see, about a market update and the market outlook, which I think is going to be really important for all of us. Personally, I would highly encourage everyone to join and be a part of our 401k plan if you're not already participating. We all know it's been what I personally would just call a crazy economic time over these past few years, and this year hasn't been the rosiest. But hopefully we're going to hear some good news, or at least news that helps us understand what's going on. I don't know if you guys have any control over it, but if you could make it better, that would be great. With that said, let me just go ahead and turn it over to John and team. Take it away.
Thanks so much, Felicia. I just want to say hello and welcome. We're so happy that everybody is taking some time out of their busy day to join us. And it's a real privilege that Jerry Thomas and the team at Decision Analyst allow us to share our thoughts on the current market outlook to help you stay informed. My name is Julie Klein, and I am your retirement plan client service associate. Beside me are John Arnott and Jerry Proter. They are your financial advisors. And just a couple of quick housekeeping items. We are recording this presentation, so if you wouldn't mind putting yourself on mute during the presentation, you can ask questions in the chat room, and we will either get to them during the presentation or after. And this replay will be available in your archives, Felicia has said, in order to watch it afterwards, replay it, or for those who have missed out on the presentation today.
Okay. Could you hand me that?
What we're going to cover today on the agenda is the current economic indicators, including the market valuations, earnings growth, and inflation. We're going to talk about the interest rates and the impact on fixed income, international and China impact on the current economy, and investing principles.
So we start out here, thank you, Julie. We start out here with exactly where are we with the S&P 500 and basic equity valuations. And if you can see the middle line there is a 25-year average for earnings per share, or for the last 25 years. 16.76 is that number. And as you can tell, during the pandemic, we had a huge spike. So people were at home, they were spending money on new technologies, they were doing things that they don't normally do during work. And as a result, we had this huge increase in earnings per share, and it has fallen pretty dramatically since then. Then we had a little spike up again at the beginning of 2022, and then now, as you can tell, it is still kind of coming back down, and especially this past month of October hasn't been especially good for the stock market, has it, Jerry?
No, things kind of have been volatile. The volatility is driven by the economic conditions, interest rates, a variety of things we'll talk about. I think the important part is that the ratio, which is price to earnings, is coming down to the more normal 50-year average.
Sure. This is exactly that. This is an example of what we think potentially could happen as far as earnings per share growth in the future. So this is 2020. The blue lines are 2024, 25, and 26. And you'll see that the biggest difference here is in the upper right-hand corner. Margins have dramatically increased. So the profit margins for companies have gone up. Revenues, on the other hand, have gone down a little bit, but they've used those excess earnings to buy back shares. So our average number of shares that are outstanding in the S&P 500 holdings has come down as well, which also will cause a better earnings per share number.
So really the good news is that the stock market is a forward-looking scenario. And in a forward-looking right now, we're looking at productivity growth, profit growth, and the prices on stocks are still low. So as we go forward to 23, 24, 25, we anticipate that this growth in earnings is going to drive the market up.
So this is exactly what everybody's been experiencing in the S&P 500. You'll see the green line on the left-hand graph is the top 10 companies in the S&P 500. And there's a dramatic difference since 2019 as far as what those companies have been earning. And so it's kind of a disparaging thing when you have 490 companies, which is the darker line, are not making quite as much money as those top 10 companies. We have this issue. My personal opinion, I think it's happening, is that we're going to see those 490 companies will begin to increase their earnings. And we're also, unfortunately, we're going to see those top 10 companies, those earnings are probably going to get a little less growthy in the short term.
So that green line is primarily the largest tech companies in our composed companies of the market. So 10 companies have driven that index up above the norm, but the average 490 are still value oriented.
Pretty flat.
What's happened though in the last few months, August, September, and October, is those 10 companies that we're referring to in the tech sector are coming down in value to match their earnings. And that's going to be more pro rata, longer term, better results.
And we're going to see some more of that as we go through this slide.
Right.
Yeah. All right. So one of the big questions that we all have is, well, we've been through a lot with COVID and whatnot. And right now we're at a $6.2 trillion budget. And with continuing budget deficits and now this extra spending, the top left-hand graph is indicating we're actually going to have to borrow $1.4 trillion. And moreover than that, we've got to pay the interest on $1.4 trillion. The upper right-hand graph kind of shows you the difference between principal payments and interest payments on that debt. And the blue that's inside that graph is that interest payment. Talk to us a little bit, Jerry, about that bottom right-hand graph. That's the one that is worrisome to me.
So this process we're going through in the short term is creating a lot more borrowing than there is demand right now. And when that occurs, interest rates float up in the market until it's attractive enough to buy those bonds and hold them. So in the short term, so we're seeing the bond market interest rates go up.
So we've issued $1.4 trillion worth of debt. And in order to make that something that somebody wants to buy, we have to actually raise the interest rates on those.
Yeah, so the market is sort of a self-correcting situation. So when you hear the Fed saying higher, longer, they've already increased the short-term rates they now feel that the rest of the market is adjusting rates without them having to do anything. So we believe they're going to hold their rates, letting the market do its own thing. In the long term, because we're going to have to pay more and more interest on debt, we anticipate there'll be pressure to have rates go down, which will help both our economy thrive as well as for the federal government to be able to have the ability to make payments on a debt. If you take a look at that upper right-hand chart, though, and you go back, you can see that that blue line has exceeded the gray in the past. And then we've had periods where we've been back in alignment, where the economic growth and income for the country has well covered that debt. So we're hoping and anticipating in long term, that balance will come back in line.
I think we're beginning to see that too. So this is an interesting graph. This is the consumer savings and borrowing. And as you can tell from the left-hand graph, during COVID, there was an enormous amount of savings. Some people were being paid and they weren't working. Others were taking advantage, many of us taking advantage of $2,400 bonuses from the government to try to get us through this period of time, which increased our debt. And that savings rate has come down pretty dramatically since COVID. And one of those issues is that's why inflation has really taken a hold, is that we've been out there buying products, and when we have scarcity of product, prices go up to meet that demand. And that's the basis of our inflationary issues right now, right?
Yeah, so it's like we've been through a tsunami. That tidal wave started back in Asia and China and kind of rippled through the world, and we shut everything down. So even though we were making money in one manner or another, where we kept working and got government funding, our savings went up because we weren't spending it.
Right.
And then when things opened up again, we began to spend it, but the supply line wasn't catching up to our demand. So we got this inflation that we're trying to control. And as we can see in a consumer side, we think the consumer is very healthy, even though credit card spending, which is the lower right side, shows revolving debt going up. It's still way below the long-term average, and we still have more in savings than we had before. So we anticipate that we're going to roll through this in a logically good manner.
But at the same time, this is one of the worry points for the Fed, is that spending all the savings isn't necessarily as good in an inflationary time.
Right.
Yeah.
So we're hopeful that the buying rate and the spending rate will adjust proportionately and bring things back in line.
So this graph is dealing with labor. And so the upper left-hand graph is non-farm payroll gains. And as you can tell, since 2021, we've seen a steady decrease in payroll gains for non-farm. The interesting graph, I think, is the one on the right-hand side, which is the two blue lines. The lighter blue line is age 24 to 54-year-olds and their participation in our labor market. The darker line is 55 and over. And you'll notice that when COVID hit, a lot of those folks that were over age 55 decided it was time to retire and get out of the workforce. It wasn't worth them to work and be exposed. And many of those have stayed retired, but you'll see there's a little tail on the end of that might indicate that some 55-year-olds or whatnot are going to have to go back to work. The bottom graph is more dealing with the labor market from 2020 all the way through 2023. And red in each of those different sectors means that there was a deficit, not enough employees in that particular area. And then we hit the recovery period for 2021 to 2022, where things were really greening up. And then now for 2023, we're kind of seeing some more yellow and some cautionary signals.
Yeah, so if you kind of connect all these graphs and dots, what we're dealing with is we came out of COVID and we had 12 million job openings, which was 2 jobs for every person that was looking for a job. Fast forward to today, we have dropped to below 8 million job openings, and we have less than 1.5 jobs per person. So the competition for people is what's driving that wage inflation down. And there are more people participating, as you can see in the right chart with the blue line. So that combination is easing wage inflation.
Okay, so to dovetail onto that, Jerry, we actually received a question as far as how AI is impacting, whether it has a beneficial or a detrimental impact on employment and jobs creation.
So that's a very interesting double-edged sword, I would call it. Technically, AI is supposed to replace a bunch of people in various positions because it's going to, quote, take over. However, when you look at our longer term population growth, it's really muted. In other words, we're not creating a whole bunch of population, new people to enter these jobs. So technically, we're going to have less people available. On the flip side, AI is going to reduce the number of people we need. So we are hoping for a balanced outcome. And usually any sort of technological improvements have really been beneficial to the economy and created all kinds of new jobs that we didn't know about before. So we're kind of optimistic that this is going to drive our country and economy to better places.
And that inflation question is what we're dealing with on this slide. And you all can see the gray lines indicating there have been 7 different recessionary periods since 1973. And the length of those recessions, it depends on how wide those areas are. And that core inflation rate that we've been experiencing is what that dotted line represents all the way across. And there are 2 types of inflation that we're dealing with here. We're dealing with headline inflation and then the consumer price index. And Jerry, what's the difference between those?
Well, consumer price index includes, quote, everything. The core inflation excludes food and energy. Food and energy is very volatile and doesn't always have a supply-demand factor associated with it like everything else. So on the good news side is both these items are dropping year over year, and we can see that it's going back to the normal. We anticipate that this will continue. So far, inflation has been talked about for a couple of years, and recession has been also talked about, but it hasn't come. So the good news is the economy is continuing to grow, but slower than it was. On the employment side, we continue to have low unemployment. And usually the combination of those 2 things bid for either a very short period of time for recession or no recession.
Very good.
So we're anticipating a soft landing, as they call it.
Or maybe in industry by industry recession, or a kind of a rolling recession, if you will. So this is a graph of interest rates, and the basics here are on the right-hand side of this graph, where we believe that we've really peaked out in interest rates. It's going to bode well for some parts of our economy. And as we can say, reading the headlines today, if you're going to get a new mortgage at 8%, it makes some housing pretty tough to buy currently.
So we talked about this quote rolling recession. So if you're looking to buy a house, the mortgage rates are so high, it makes it much more difficult to afford. People that already have their homes at low interest rates are not moving, so those houses are not coming on the market. New construction is coming at a slow rate. So those two things are kind of balancing each other. But we see that house prices have levelized. They're not jumping up. Conversely, when you look at apartments and multi-family residents, we've built so many units here lately that we're beginning to see the vacancy rates go up in apartments, which is bringing rents down, and inflation associated with that is coming down. Yeah. So there are a few things that this higher rate is already impacting, and that's why we anticipate that we're peaking out of that cycle. But nevertheless, this aggressive increase in this shorter period of time, and if you can look back, it's been the most aggressive risk we've followed through. Interest rates really impacted.
Interest rates have never gone up this high, this fast in history, and that's right. Kind of leaving everybody's economic head spinning because of that.
Right.
So this is an interesting story as well, with fixed income valuations. I personally think that this slide may have a lot to do with what maybe decision analyst clients might want to consider some more bond participation in their portfolios. But as you can tell here, in each of the different sectors of bond participation or bond issuance, that's what this graph is indicating. The blue triangle is the peak interest rates that are showing up in every one of these areas. And the pinkish line, if you will, is the average. So when you see this disconnect that's happened, and this is a historic disconnect, potentially buying bonds might not be a bad thing to do, because as interest rates go up, bond values go down. So we've experienced that. As interest rates come down, bond values go up. Now, it's not going to happen fast, but what's your opinion of what this is showing us?
Well, again, long-term rates, average, are definitely lower than we are today. We do believe we're peaking out on this interest rate cycle, and it bodes well for bonds appreciating and returning some very high returns, and blended or balanced portfolio is going to look very, very good going forward.
Very good. International valuations. We always hear a lot about, well, is it looking at earnings per share for the United States versus the European countries and international. There's a lot of difference between earnings per share or pricing on their stock markets versus ours. Tell us what you see here.
So Europe entered recession already because of many factors, including European war and dislocation of supplies to Europe. And that recession that they're going through has created a disparity of value. So their values relative to our values in the US are significantly lower. And the companies in many cases are just as good as our companies as far as what they do and the money they make. It's also there on the right side where you look at yields. What kind of dividends are these companies paying? Well, they continue to pay good dividends, and because of the prices being so low, their dividend yields again are better than ours. So there's opportunity, I think, in that marketplace to have some of your money allocated towards international. and anticipating some good returns there as well.
But again, you'd be looking for more dividend paying companies in an international setting as opposed to pure growth type companies.
Yes, I think our emphasis is on quality on going forward investing.
John, Jerry, we just received another question as far as when we were talking about international markets, is that, how do you see the international, the global conflicts impacting what impact that will have on what the Fed does to interest rates?
Well, I think the global impact is being felt right now. We've been in this European war with Ukraine, Russia. We now have some Middle East issues, and that's always disruptive, and uncertainty leads to market volatility. However, we see that these valuations have come down significantly. So rebalancing and anticipating global growth coming back is going to enhance and improve our investment returns.
Well, this is specifically speaking toward China, and we hear an awful lot about our relationship against or with China, depending on which side of the you're on there. Talk a little bit about what effect China has had on us.
The reason we hear so much about China is for several items. One is that that's the second largest economy in the world. And that economy was forecasted prior to this COVID cycle to outtake or exceed our economy by 2030, 35. Well, they mishandled the recovery and or dealing with COVID. So that economy was shut down. And because it was shut down, it slowed global growth down. So now they're stimulating their economy, and that stimulation is going to help them grow again. And as they grow, the rest of the world grows as well. So we're anticipating that to drive some growth in the future.
Having said all of that, though, my concern, and I think the rest of the world has learned, that you can't rely on just one country for your basic necessities, whether that be computer chips or the ingredients in ibuprofen and acetaminophen. We've got to expand where and how we get those raw products to our country as well, or a more stable overall supply chain.
So there's sort of a re-globalization, if I may call it that, where we're reallocating and diversifying where we get our products and services. So a bunch of stuff is really stimulated and being built here in the US, battery plants, chip plants. So there's a stimulus happening. There are mines that have precious minerals that are required for magnets and EV that are coming into effect here in the US that we haven't had in years. We're buying less from China. However, we're buying more from Canada and Mexico. So the control of bringing things back to friendly countries. And then with the disruption of oil supplies in Russia, that's kind of globalized itself as well. So Europe has diversified where they get their energy from.
Yeah.
So all that has obviously created enough disruption to create this inflation, but things are adjusting, and that adjustment's going to create more what I consider normalization.
Well, Jerry, this is called a Callan chart, and it's one of my favorite charts because it kind of looks at every single year from 2006 through 2022. And the white line that we've kind of drawn through the center of all that looks at a balanced portfolio. And a great example of a balanced portfolio is our target date funds. So Sometimes a particular sector of the economy is going to do better or worse. But if you have a balanced portfolio, you're going to avoid the big losing times and potentially take advantage of some others. What do you take from this chart?
Well, the chasing returns is tough, because if you look at the color of the boxes, they're all over the place. They could be at the very top one year and make it all the way to the very bottom the next. So we're always looking at a balanced, diversified portfolio, and doing that for the long term will give you better average results than trying to chase the best return there was, because we're kind of looking at yesterday when we do that. And the markets are really looking at tomorrow and the future.
Yeah.
So again, balanced is better, and longer term, higher and better results.
We have very few 401k participants that move their money on a regular basis. And so I think it's a really good idea to look at this and make sure you're on the right trajectory for what your retirement needs to be. But this is not something that you should be looking at on a daily or weekly basis, maybe quarterly or semi-annually, taking a look at your portfolio and making sure that this is going to meet whatever your long-term investment objectives are, right?
Well, and when I say balance, and when we're talking about diversification, it's really a risk measurement. So if you're a high risk person, your balance is going to include more stocks. And if you're a low risk person, your balance is going to include more bonds.
Mm-hmm. Sure.
But it'd still be diversified among many asset classes.
Very good. All right, so this is also important, and that is it may not be timing of the market, but time in the market. And that's what this graph indicates here, is that in any 1 year time slot, you'll look at the disparity between high and lows. But the further out you go, the less volatility involved in your portfolio. So a longer term look at 5 and 10 years down the road, as opposed to looking at everybody's return every single year, is what we're trying to communicate here, right?
Yeah, but one of the things I've seen is that in high volatility periods like we have now, and people worried and looking at their portfolio every day, there's a tendency to quit investing or putting money in. Technically, when things are low, you should be putting more money in.
Well, that's how Warren Buffett does it. When there's blood in the streets, he's buying. And when everybody's fat, dumb, and happy, he's selling to those folks.
But emotionally, I'm on the opposite
Yeah.
direction. I feel terrible and I don't want to lose more money.
That's the investing game right
Yeah.
there, is trying time in the market.
Right. Bottom line is time in the market gets you positive results. And that's been a repeated over and over and over history.
All right. Well, so we really appreciate the opportunity to share with you some of these slides. I hope this spurred on some questions. We're available to answer questions. As many of you know, we do regular Zoom calls with our clients, and every one of you is a client of Coble Craven. So call up, talk to Julie, schedule a time where if you want to look at your portfolio and see what's happening, that would be terrific.
For that matter, if you have questions about anything associated with financial planning, because that's what we do, is a holistic view, we're available for any of these questions associated with anything that you have to deal with.
And as you maybe absorb some of this information, because I know it was a lot, if you have follow-up questions, feel free to send them to John or to Jerry or myself, and we'll get you an answer, and we'll email you right back out with those.
Felicia, thank you very much.